Hello, and welcome to our final panel presentation for the day, Homeownership in Indian Country. Housing in Indian Country, and homeownership in particular, has long faced distinct challenges. In turn, Native entities, alone and together with other public and private sector actors, have responded with a variety of programs and initiatives to help further homeownership opportunities in Indian Country. Today, we will hear from three panelists who will help us better understand some of the challenges facing homeownership in Indian Country, particularly with regard to access to capital, and who will also present recent developments and emerging opportunities to grow equitable access to capital and lending in Native communities. Let me briefly introduce our three panelists. They will each present for about 13 minutes, after which we hope you will all engage with them in a robust questions and answer session. Please feel free to submit questions as the panelists speak using the Submit Questions window on your screen. We'll hold all the questions until the conclusion of the third presentation. Now, to introduce our panelists. First, we'll hear from James Robert Colomb, who's Project Manager at the Center for Indian Country Development, and he will provide an introduction to some of the key issues confronting homeownership across much of Indian Country, and then focus in on opportunities to improve the process of handling title status reports, a key component in mortgage lending on tribal lands. We'll then hear from Miriam Jorgensen, who's a research director at the Native Nations Institute at the University of Arizona, and she will present some key findings from a survey of lenders engaged with mortgage lending on South Dakota's Indian Trust Land. Finally, we'll hear from Krista Langholtz, who's Chief Operating Officer at the Owista Corporation, and she will discuss opportunities and challenges for Native CDFI housing lenders gleaned from survey research and interviews with CDFIs supporting mortgage lending in a range of Native communities. With that, let me hand the mic over to James.
Thank you. Today, I'm going to talk about the Fed's work on Indian Country homeownership and my recent article on title recording for tribal trust land. So, the Federal Reserve is a central bank of the United States and is governed by the dual mandate, maximum employment and stable prices, where stable prices generally means a targeted inflation rate. Under those missions, the Fed performs a number of duties beyond the setting of interest rates at the Federal Open Market Committee. As part of the maximum employment mission, the banks work with communities that are underserved and underdeveloped. Minneapolis Banks District has 45 federally recognized tribes, significant tribal populations, and many acres of tribal land. So the Minneapolis Bank has had a special focus on Indian Country development for over 30 years. In 2015, the Center for Indian Country Development was founded as the culmination of the bank's relationship with tribes and focus on tribal communities. While based in Minneapolis, the Center for Indian Country Development is national in scope. We work on research questions and policy priorities that matter for tribal nations and indigenous peoples across the U.S. Housing and homeownership remain critical topics for us in our focus on capital access and finance. I'll talk a bit about why the center has worked on homeownership in Indian Country. According to a 2017 HUD survey, 75% of American Indians on reservations report a strong desire to own their own home. That study estimated that, as of 2015, 33,000 new units were needed to eliminate overcrowding among natives living in tribal areas, and that another 35,000 units were needed to replace severely physically inadequate housing stock. At the same time, tribal economies and the financial capacity of tribal members are growing. Over 40% of reservation households have incomes near or above the U.S. median, and over 50% of borrowers living on reservations already have prime credit scores. In other words, there are many Native Americans on reservations that want homes and many that can afford homeownership. However, there are several barriers to tribal homeownership. Today, I'm going to share a colleague's research on mortgage pricing before discussing my recent article on land title. In The Higher Price of Mortgage Finance for Native Americans, Professor Donna Fair examined HMDA data for racial disparities. She looked at first lien home purchase loans exclusively and used a framework of high-priced loans, which are defined in the data set as loans that have a rate greater than or equal to 1.5 percentage points above APOR. In the HMDA data from 2010 to 2017, used in this study, interest rates lower than that are censored and can't be seen for research purposes. Professor Fair, in this context, asked two questions. What proportion of Native American loans are high-priced, and what is the rate spread of those loans? For the years that were examined, from 2010 to 2017, Native Americans had a much higher proportion of loans that were higher priced than the other category here, where other is everything that is not Native American, African American, or Hispanic. As an example, in 2017, 14% of AIAN mortgages were in the U.S. were high priced compared to 8% for that other category. For loans that are higher priced, Native Americans pay the highest average rate spread of any population group by a large amount over the entire range of the data. Notably, the other three categories of high-cost loans have relatively similar rate spreads, while the Native rate spread stands apart. These last two slides don't capture geographic differences among Native Americans. Over 70% of Native Americans live in urban and suburban areas, and natives in cities and rural reservations can face different challenges. Here we have the proportions of Native Americans and non-Native Americans with high-price loans living on reservations and living near reservations. Using census tract data, the researchers compared reservation tracts and tracts bordering reservation tracts. The proportions of high-cost loans in the other categories are almost identical over these years, whether on or off reservation. However, there is a huge difference between the proportion for natives. For natives living near reservations, the proportions are not much higher than the other categories, and this perhaps speaks to the fact that it can be easier to find housing off reservation. Natives living on reservations have a higher proportion of high-cost loans than any of the population categories I showed you on the first graph. For much of this range, compared to non-natives, American Indians living on reservations were 3 times more likely to have a high-cost loan. Looking at the rate spread above APOR using those same categories of natives and non-natives living on and off reservation, we see similar results. What does this actually mean for natives living on the reservation? For a 30-year mortgage in 2016, the difference in rate spread for natives and non-natives on reservations with high-price loans, the gap between the blue line and the black line, translates to an additional $107,000 in interest that the native has to pay over the life of the mortgage. In 2018, the data was changed so that we can see interest rates below 1.5 points above APOR. This means we can see the entire range of interest rates rather than only those for high-price loans. Here we have a breakdown of AIAN and white on and off reservation. While the lines are close up through the first 3 quintiles, where the lowest interest rates paid are on the left and the highest rates paid are on the right, the average for Native Americans paying the highest rates for mortgages blows up at around the 70th percentile. This is the manufactured home subset of the same data. Natives living on reservation pay very high rates across the board. In short, mortgage pricing is a serious issue both for access to housing and access to capital, especially on reservations. The new work I want to share is about land title for tribal trust land. TSRs, or title status reports, which are prepared by the Department of the Interior, are widely reported to slow down home mortgages on tribal land. This is a long-standing problem, and we have proposed solutions based on conversations with the Bureau of Indian Affairs, lenders, and our partners working on tribal home ownership. I'm going to define title status reports, or TSRs. Even tribes and lenders that specialize in Indian country can find this issue confusing. The Bureau of Indian Affairs plays a role in managing over 50 million acres of tribal trust land. Legally, this is land that is held in trust by the federal government for the benefit of tribal nations and individual Native Americans. As a result, the ultimate responsibility for recording trust land title documents is with the federal government. The BIA uses the Trust Asset and Accounting Management System, or TAMS, to generate TSRs, which cover legal descriptions, liens, transactions, and all other supporting documents for a tract of trust land. The BIA self-describes this function as, quote, similar to recording at a county recording office. There are 3 kinds of TSRs, adding to the confusion but an important distinction. Informational TSRs are printed directly from TAMS without additional verification by BIA staff. First certified TSRs record the tribal lease to the home buyer and were required by mortgage lenders. The final certified TSR records the mortgage and are necessary to sell the mortgage into the secondary market. Thus, both the first and final certified TSRs are essential to the trust land homeownership process. The issue I wrote about is that extended delays in the delivery of both first and final certified TSRs disrupt the home mortgage lending process for Native Americans. At a Senate Committee on Indian Affairs hearing in October 2019, A tribal leader from Montana testified that tribal members have waited for over a year for certified TSRs. Put another way, while the national average for mortgage close time is around 6 weeks, for trust land, title alone can take over a year. The result is discouraged homebuyers, frustrated lenders, and a barrier to additional housing stock in Indian country. The federal government has acknowledged that the timely delivery of certified TSRs as a specific concern for tribal home ownership since the Clinton administration, with multiple memos from the BIA attempting to address this issue over the last 25 years. However, reports of delayed TSRs and a lack of transparency in the timeline continue. This bureaucratic failure is ultimately an equity issue for Native Americans attempting to unlock the full economic potential of land that belongs to them. The goal of any BIA land management reform should be to achieve efficient and reliable processes for developing trust land. BIA offices should understand the importance of their role in supporting tribal communities and economic development. With respect to homeownership, the BIA should strive for equity in individual Native Americans and for tribal nations pursuing residential land development and trust land mortgage financing, That is, BIA processes, including the production of certified TSRs, should match industry standards for home loans on fee-simple land nationwide. CACD recommends the following actions to improve the BIA's TSR process. First, the BIA is a large organization with many regional offices. Some of those offices already process TSRs in a timely manner, or at least a manner that is satisfactory for the tribes that are affected. Whatever solution is implemented to fix this issue nationally, we don't want to hurt performance that tribes are already happy with. Second, the BIA should regularly report on TSR timelines. Unless we can know which offices and how long or where the problems are, we aren't going to be able to identify best practices or even the ultimate cause of the delays in question. The BIA has already committed to a 30-day or shorter timeline for TSRs in their internal memos and procedures. Bringing the entire organization into compliance with those deadlines would be a major improvement. One possibility is to require the BIA to meet those deadlines with statutory deadlines, but it is unclear how to effectively enforce a statutory deadline. The BIA process should be a 21st century process. There should be an electronic portal for the submission and tracking of mortgages and all related mortgage documents. Borrowers and lenders should have transparency and with that electronic access to BIA processes. The real goal of this work is to increase housing stock and homeownership in Indian country. We support an interagency report card that tracks the delivery of TSRs as well as federal housing products from the USDA, VA, HUD, and any other relevant agencies to identify problems and increase accountability in a collaborative fashion. Lastly, the BIA should consider centralizing mortgage processing. Some BIA offices only rarely receive mortgage applications. Centralized expertise would relieve this burden on a regional BIA staff, while also potentially increasing transparency by providing borrowers and lenders with one office where questions can be directed. Again, the issue of TSRs and homeownership is about tribal nations and Native Americans having administrative equity and access to capital. The management of tribal lands by the federal government is a centuries-old issue, and TSRs are just one facet of the concerns that tribes have. And that's the conclusion of my remarks. I want to thank my colleague, Dr. Donna Fair, for helping with that research, and all of our external partners that helped us figure out the complexities of the TSR issue.
Thank you, James. So we'll turn now to hear from Miriam Jorgensen, who will focus our conversation a bit as we look at mortgage lending in South Dakota. Miriam?
Thank you very much, Chris. I also want to give a thank you to Freddie Mac for inviting me to present at the Rural Research Symposium and for being one of the sponsors of the research that I'm going to talk about today. There are a couple other acknowledgments I want to make. First, to do a brief land acknowledgement. As Chris noted, I'm from the University of Arizona, and the University of Arizona is located on the homelands of the Tanatam Nation and also on the lands of the Pascua Yaqui people. I also want to acknowledge two other organizations, Hope Nation, which is the consulting firm that did this research with me, and my two colleagues in the work who work for Hope Nation are Stephanie Gutierrez and Kristen Wagner. And then just finally to acknowledge the South Dakota Native Homeownership Coalition, which is working to bring together partners to increase homeownership in the state amongst its Native population. And with that, I'll just get started. I want to tell you a little bit initially about this survey, which was conducted in 2019. And so this is a bit of a roadmap. As I said, I'm going to talk first about the survey and then through kind of the different parts of the findings where we talk about barriers and serving borrowers and obviously, of course, conclusions and recommendations at the end. So this 2019 survey was motivated by ongoing feedback from the field. And if you listen closely to the beginning of James's presentation, he talked about some survey work that HUD did in 2017 that indicated how many people living in Indian country are interested in home ownership. This actually echoes a finding that came from a very different source of information as well. In the lead up to the Access to Credit and Capital Report, which was issued by the U.S. Treasury in 2016 and 2017 in two parts, and that I helped author, one of the things that we heard in the focus groups and in the consultation sessions from people from across the United States, whether or not they're living in Alaska or in Oklahoma or in Arizona or in North Carolina or in Michigan, you get the point, is that Indian people who live interest in home ownership. And so a lot of this effort that we're making in terms of really trying to understand what some of the bottlenecks are in the process is in a sense responding to this important change in Indian country. And I think it's important to consider that there have been housing programs serving Indian country for quite some time, but many of those housing programs are related to the low-income housing programs that serve other populations in the United States. And we've seen a concerted change in Indian country where many Indian homelands are experiencing what I might term a sort of rise of the middle class. So much of Indian country is still poor, but there are large swaths of people who live in Indian country now who are experiencing increases in income, largely because of the results of the self-determination movement, which have created new economic opportunities for tribes and tribal governments, and tribal citizens have benefited from that. So there's a group of tribal citizens, as James emphasized, who are able to afford housing. And so these questions around home ownership, so these questions around how to get them into home ownership become critically important. So this study looks narrowly at the question of lending and lenders active in the state of South Dakota. And as you can see from this slide, we didn't have a huge response to this survey. In part, that's because there are not a lot of active lenders on lending on trust lands or Indian trust lands in the state. And more than that, there weren't that many people who responded to the survey, that many institutions. But we did try to get some broad representation. So we're looking here at what we call practitioner lenders, which are largely native CDFIs, which I know that Crystal is going to talk to you about next. And then we also talked to commercial lenders, so traditional banks as well. And then finally to what we termed institutional lenders, which are things like USDA Rural Development, which has some lending programs as well. So we did get responses from all those different kinds of lenders. So on one hand, this is somewhat representative of those lending types, of those types of lenders and folks who are active and not active in the industry, although the response rate, as you saw, is reasonably low. So at best, I want you to think about this as an indicative set of answers that tell us something about what's going on in the field, but of course, it's useful to get even more information. So just to walk through some of the kinds of results that we were finding, one of the first questions we asked was really just this: what do you perceive as a barrier to lending? Now, I want to emphasize that idea of perceive because, again, we're asking this to lenders that are both active and not yet active in the field. So for those who are not yet active, it really is this notion of, well, I don't really know because I'm not doing the lending, but here's kind of what I'm hearing, here's what the sense is in the field, here's what colleagues tell me, etc. We listed 14 different items of the kinds of things that might be understood to be barriers. And we asked the respondents, the lenders we were speaking to and who filled out the survey, to rate these on a scale of 1 to 5. And so that scale was picking up at the low end whether or not people saw this as not a barrier, and the 5 end picking up whether or not people saw this as a significant barrier to lending on Indian trust land. And I want to just emphasize that Indian trust land is of two sorts. It's the tribal trust land, which is owned by the tribal government or beneficiarily owned by the federal government on behalf of the tribe, but in a sense, it's communally held land by the tribe. And also Indian trust land could also include individual allotee trust land, which might be held beneficiarily by the federal government for an individual Native American. So we're really looking at the question of who's active in lending on that kind of tribal trust land and what are the barriers to doing that kind of work. So in this ranking process, we looked at those of these 14 different items, which got the highest sort of scores around this is really a big barrier. And as you can see, those are the ones that on the slide have the double star there. Those are the ones that were always really on people's high rank lists of significant barriers to lending in Indian country. And these are interesting because it's not surprising on some level that borrower characteristics turn out to be things that are an issue. So here lenders are identifying borrowers' credit histories as being a pretty big problem. And then the second issue, though, is something that I think that was a little bit of a surprise to us in the survey to find out that there just wasn't enough affordable housing for purchase available. So note that what I put in there in that phrase that you don't see on the slide, but is what we were really asking about in the survey is there housing that is available for sale that folks can afford who have the money to get a mortgage for, affordable, kind of entry-level homeownership housing. And there is an issue around that. I think a really important thing that shows up on this list too, that it has a single star here, so that suggests in just simple kind of ranking system that not everybody put this down, but a number of the respondents were signaling that a lack of familiarity with the mortgage process itself was also an issue. So I'm not going to go through every one of these. You can read them, but I think you can get a sense there from the set of barriers that they come from a lot of different directions. Some are characteristics of the borrowers that require a certain kind of effort. Some are characteristics of the lenders that require a certain kind of effort. And some are characteristics of the market that require yet another kind of effort. So I did want to share with you a couple of the quotes that also we gathered in the open-ended answers that I think emphasize these kinds of characteristic barriers that we're seeing. One is here on the screen of our institution's issue is a lack of qualified borrowers. And that comes up with that credit history point that I gave you earlier. In part, it's also a volume issue. We also got some responses from folks saying that they just hadn't gotten that many applicants to come into the door. I think another really telling thing, though, and you saw this again on that barriers list, was the idea that folks also didn't have a sense that they knew that much about the market. And here is something that we really hung on to as an important quote. This came from a bank that was active lending in the market, and in a sense was saying, we need to kind of get a hold of ourselves here and realize that part of this is our issue. Instead of complaining, we need to step back and step in and try to understand and work towards understanding about this market. So a lot of the rest of the survey turned toward that question of how to get involved in the market, how to engage with borrowers, what kinds of things lenders needed to learn in order to become more active in the market. So really addressing that first question of how do you kind of get out there into the market and attract borrowers and let people know about you? On this slide, I've actually collapsed the answers to two different questions here. One of them is about this idea of how do you connect to applicants, and particularly the last bullet point is also about how do you create an environment within your lending institution in which you're going to be able to do this kind of Indian country lending. So really rising to the top of the list for connecting with Indian country applicants was this idea of collaborating with native CDFIs or native community development institutions, which I know Crystal is going to talk to you more about, collaborating with, and here's a great acronym, TDHEs, tribally designated housing entities. So those folks in the tribal government or within the nonprofit tribal housing entity that are working on housing issues, some of which is low-income rental, but then also transitioning people out of those low-income rentals when they income qualify out of that into this more middle-income housing market. So establishing good relationships with those folks really helps you engage well in this market. You can see there are a couple other things on this list that rose to the top: establishing a presence on Indian lands, using things like social media that folks are going to listen to. We continually hear that Facebook and Indian Twitter are really important places to engage if you want to get information out to Indian country. And so that was a suggestion that was coming from this survey as well, is that people felt it was important to engage in those places. And then I think this really interesting point about folks saying, if banks want to be out there and active in Indian country, they also have to develop relationships so that they can get referrals and recommendations from some of their present clients, because that's what's going to break down some of this barrier about fear of engaging with, say, a mainstream lender, or fear of not really knowing whether or not a loan is something that you can get into, or home ownership is something that you can enter into. So that notion of personal relationships really became clear in this. And finally, I want to note that also for the banks, it became really important. People were saying for the bank itself to have a commitment, for there to be senior management support, for there to potentially be specific lending goals, and for also the bank to have on its side some formal relationships with those entities like the TDHEs and the CDFIs, to not let that just be a particular individual relationship, but an institution-to-institution relationship. I don't have a lot of time left, so I'm going to actually skip ahead to a couple of important points about one of the questions we asked in this survey, which was, remember, it was a survey that one of our partners was the South Dakota Native Home Ownership Coalition. And the South Dakota Native Home Ownership Coalition is this actor that tries to respond to various needs within the sector. And one of the things that it knows it can do is offer training. And remember back on the earlier slide, we saw that one of the barriers to greater involvement with lenders was this notion that lenders themselves need certain kinds of training. Well, this question really gets at it. What is it that both lenders who are active in the market and lenders that are not yet active, what are the kinds of things they want to know? And the survey very clearly identified that there are a series of needs, of training needs for lenders. They want to know more about identifying and securing titles, the kinds of things that James was talking to you about. They want to learn more about navigating the leasehold mortgage process, which is the specialized mortgage process on tribal trust lands. They want to know more about how to reclaim tribal property, or reclaim property, or reclaim their money to foreclose in this kind of a setting. And they also want to know more, especially those who are not active in the market, just about the history of Indian trust land, in a sense, the history of Indian country. I want to delve into one really critical area of this training need, which is an issue around how to mitigate risk. And this gets to that issue of sort of how to foreclose and how banks can be assured that they're not going to lose their money. We got some really interesting questions, responses back when we were asking the question about, what do you really know about guarantee programs that are out there, the programs that exist to protect banks as they're lending in Indian country? And I want you to notice that we've separated here on this chart two different kinds of lenders. We're looking at practitioner lenders, who are native CDFIs, for instance, and then the institutional and commercial lenders, the rural development and also your traditional banks. And then we've separated into those who are currently lending and those who are not yet lending. And notice the code here is that a green dot means you've heard about this program and you use it, whether or not it's the HUD 184 lending program, it's USDA direct loans, loan guarantees, whatever the specialist lending program is. So it doesn't matter if you are a practitioner lender or a institutional or commercial lender, you're pretty usually knowledgeable about these programs, using them, and if you're not using them, you know about them, which is what this circle says. The pattern of greens and yellows is pretty the same across lenders. But if you're not lending and you're a practitioner lender, it's pretty clear you also know about these programs. It's just that you haven't really used them yet because you're not doing a lot of lending on tribal trust land. Here's the thing. If you are a not active commercial or institutional lender, these guys really don't know much about these programs. And for us, that identifies a very critical lending need. I just want to hit a couple of conclusions and recommendations from this survey, and then I'll be done. And it's this, a couple of things. First off, volume and success matter to increase lender participation for sure. We heard that lenders need folks coming in the door, or else they can't really make profit from these programs and keep them going. But that was balanced with lenders also recognizing that this is a social justice issue, and that it's important for them to develop programs that meet their institutional needs, but are also designed to really serve Native borrowers because of the ways they've been done badly by in the past, as James's presentation really underscored. Secondly, as we really saw from that, creating better access to lending is knowledge and relationships matter a lot. So building those relationships individual to individual, family to banker, but also institution to institution with institutions located in Indian country and those institutions that may not be in Indian country but are critical to the lending process. And then finally, that some creativity really may be needed to get over some of the big barriers. And I think that's the kind of thing that James and now Crystal are going to have a chance to emphasize about how, in some sense, not all the same kinds of things can apply to make these markets work. And we've got to be creative to get over some of the barriers. I hope that you can see that there's some things that banks and lenders need to do to increase their lending. But that it also some roles for a lot of other players, individuals, trainers, and other folks who occupy the market, including the federal government, to get things done. But I do think there's hope from what we've found, and I hope you've enjoyed learning more about the survey. And if you want to read the full report, it is available here. So thank you.
Thank you, Miriam. And now we'll turn to Crystal and change the focus from mortgage lending in South Dakota to look at a very specific type of financial institution, native CDFI housing lenders. Crystal?
Hi, thank you so much. And thank you so much to Freddie Mac for having me here today to talk about the wonderful work of our native community development financial institutions. As mentioned, my name is Crystal Langholtz, and I am Chief Operating Officer of the Awista Corporation, and we are a national native CDFI intermediary. And I am going to be discussing some work that we've been doing, trying to support and understand opportunities and challenges for native CDFI housing lenders. So one of the questions we're asked very often is, what is a native CDFI? And just to give you some context, there are currently 69 certified native community development financial institutions. They're certified by the US Treasury, and they include a variety of different kinds of lending institutions: 5 banks, 7 credit unions, and 57 loan funds that are all focused on lending and supporting native communities. To be a CDFI that's certified, you must be representative of your community, provide development services such as financial education or home ownership education, and provide lending products designed to specifically serve your community. So we have been doing research lately trying to understand any barriers that our native community development financial institutions might have to supporting home ownership. And the driving research questions of the study that we have been conducting over the last year are: 1, how are native CDFIs currently serving housing needs in their communities, and where do they want to go in the future? The other issue that we've been looking at are, what are the structural barriers that impede that movement? How can we remove them, specifically focusing on the secondary market and secondary market access? So I want to express my deep gratitude to several different folks that have been helping with the study, including Sweetgrass Consulting, as well as the many, many native CDFIs that have been gracious with their time as we have tried to consolidate our findings and have been there to give us sound and wonderful advice. But the methodology of our study included a survey that went out to all of our native CDFIs, of which we did have 30 respondents. We had 13 that want to do housing lending and 17 that currently provide housing products. Now, all native CDFIs, the 69 that I mentioned, they provide a variety of different products, including small business lending, consumer lending, and housing lending. And so we actually, this 30 native CDFIs that participated in the survey are probably a fairly representative sample of those who are engaged in the housing space or want to be in this short time frame that we looked at here. We also did key informant interviews with 14 different Native CDFIs, and then such gratitude to a housing advisory board that was sponsored by Freddie Mac over the last year, where we have been engaging with Native CDFI participants on a monthly basis, learning more about their challenges and need, which also informs our findings with this study. So I want to take a step back and ask the question, why do Native CDFIs matter to mortgage lending in Native communities? So first and foremost, I've provided some statistics here about the Native mortgage lending market that shows that between 1994 and 2015, only 10% of the HUD 184 guaranteed lending was done on tribal trust lands. And that is, of course, for those of you who might be new to this space, one of the major market forces, as far as Miriam, of course, discussed the different federal programs out there in risk mitigation. The HUD 184 Guarantee Program is one of those major federal programs, but only 10% of that lending over time is actually making it in tribal trust lands. Where in that comparison, if you look at our Native CDFI loan funds last year, 79% of the reported lending done for housing was on those tribal trust lands. So they stand to be a huge force. And because of their deep commitment to community, a huge force in answering the question of how are we going to reach this market, whether it be through referrals and partnerships, whether it be through brokering, whether it be for direct mortgage lending, whatever their support in that space is going to be, they stand to, in some ways, serve as at least one of the answers to how are we going to make sure that we are actually doing mortgage lending on tribal trust lands. And Native CDFIs, as Miriam discussed, are deeply interested in this space. In 2018, we did a study trying to get a snapshot of our broader Native CDFI industry, and 40% of Native CDFIs surveyed wanted to add a housing product in the next year. And just to give you some sense of this, we're seeing this all throughout the Native CDFI industry. The annual loan volume growth for Native CDFI housing lenders from 2019 to 2020 was 89%. So there is huge interest and engagement in this space. And so it's an important question. How do we support this market? How do we provide them access to all the different resources that are available to them? So I chose this quote to highlight the true power of Native CDFIs in this space, why they're really, really great at, whether it be the home buyer readiness concerns that Miriam shared about credit scores, whether it be all the work that they do. But why are they so effective? And I loved this quote a Native CDFI executive director provided. We can identify the needs of our clients and community. We can relate it to culture, and we work with them on an individual level. So to give you some sense of the current Native CDFI housing activities, there was approximately, from the survey that we most recently conducted, approximately 13 million in housing lending last year from the 17 housing lenders who participated in our study. And 67% of those Native CDFIs provided. And what I think is really important as we think about this, what we discovered was in the survey, the largest challenge to home ownership that they identified was access to capital. And yet only 20% of Native CDFIs said that they felt confident in their knowledge of how the secondary market worked, what kind of secondary market forces might be affecting their access to capital, and how they could somehow participate in that supply chain that leads to the secondary market. So if you think about that, how capital happens in home ownership is through, in some way, being connected to the secondary market chain. There's clearly a gap here that we can really be thinking about how to fill in order to support mortgage lending in Native communities. So here's a slide. It gives some of the products and services that our native CDFIs are offering. You can see that, especially in that mortgage products and services, that many of them are providing their own CDFI loan or portfolio loan, and then many of them are doing some packaging for the various programs for conventional lenders and other sources. And this chart here, we did ask the question, what are your goals? So what, as you think about what you look like over time, currently, next year, and what your ultimate goal is in this space, you'll see that there's a real excitement here about fulfilling different functions in the mortgage lending space. So you'll see a lot of them are native CDFIs are currently portfolio lenders, and they really want to offer those niche portfolio products. And they, as far as we can tell, they want to keep having those amazing products that are really designed to serve their communities. But they also want to be part of this effort to diversify the products that they offer and are available through serving different functions, whether it be mortgage brokering, doing correspondent lending, or over time, even becoming direct sellers themselves of various conforming products. So with that, we ask questions, what are your barriers to achieving those goals? And this is no surprise, and this echoes, of course, the slide that Miriam shared around barriers that lenders were seeing in South Dakota. But of course, the largest one here was the qualified homeowners and the housing stock. So right in line with Miriam's findings. But then we also saw some other issues start to pop up, such as NMLS licensing and down payment and closing cost, and then needing to build internal capacity through staff in the mortgage lending space. We did ask some questions about the secondary market. Are you interested in participating in the secondary market in some way? And this goes back to my comment about native CDFIs wanting to diversify, but they absolutely do want to participate in the secondary market in some way. Those that said no did want to stay portfolio lenders and felt really comfortable in that space and felt like they had a product that really met the needs of their communities. But the other 67% here really felt like if they could address some of the barriers, that they could somehow participate in the secondary market in some way. And the barriers that they did see were gaps in underwriting criteria in portfolio loans to conforming products, which I have a slide on that I'll show, the insurancing and licensing requirements that were necessary, especially for NMLS licensing. And then also being able to, with some of our GSEs, there might be requirements for MOUs with the tribe. And some of our native CDFIs identified that as a concern. So I just want to, this slide, of course, is small, but I did want to provide it as a resource for you to look at later. But here are the various different programs that are available, those wonderful guarantee programs that Miriam highlighted earlier, as well as some of the direct loan products that are out there, as well with a comparison on the far right of the mortgage products of our native CDFIs. What are those portfolio loans look like? And I just want to stay here that the gap really is not that large on a lot of these products. The ones where we see large gaps are around the down payment required, which is to say, many of our native CDFIs are doing full financing on their mortgage loans. And we also see gaps in the credit score requirements. But they are not generally that far off and far afield from the kind of wonderful portfolio loans that our native CDFIs are offering. So then the question then becomes, how can we support this emerging market that's doing such amazing work in this space? And I just wanted to provide here, this is the capacity building needs that they identified for supporting secondary market access. They've provided training needs. So training, would be the opportunity to come together and learn in a larger group setting. around capitalization for housing, housing loan products, underwriting, mortgage licensing training, how to navigate the loan construction process and how to support borrowers in doing that. And then, of course, this showed up on Miriam's as well, becoming a HUD 184 lender. Technical assistance, that one-on-one support that they might need to really come and grow stronger in the space included that sort of best practices and sharing that Miriam identified too. They wanted to work in a cohort to seek mortgage certifications, all work together in partnership on these challenges. And then they needed a lot of business planning support, right? So there was that sense of here's the full spectrum of how we can fit into the secondary market space, but where should we go? Where does it make sense from our capacity, for us, from a cost benefit ratio, from our strategic direction, where do we best fit in this space? And so needing a lot of business planning support to figure out where it would be best for them to come together to support mortgage lending. And lastly, I just wanted to leave you with this quote from a native CDFI executive director, kind of highlighting some of those capacity building needs that I think was really interesting and telling as far as their perception of participation in the secondary market. But if you want to engage the secondary market, you have to dedicate all your energy and focus and resources into this. It's not easy and it's not cheap. But our native CDFIs do incredible work and incredible things. And I just want to, once again, express my gratitude for the opportunity to share their stories with you all.
Thank you, Crystal, and thank you, Miriam and James, and thank you to everybody in the audience who joined us today. We really hope you enjoyed these presentations. We're now going to move into the discussion and Q&A portion of the session, and while I can get us started, we're really counting on your engagement, so I'd encourage you to please submit any questions you might have via the Submit Questions Here box on your screen, and with that, we'll turn to the discussion and Q&A session. So, Indian country homeownership is at the same time a very specific topic, as there are important commonalities in the housing, including housing finance and economic conditions across much of Indian country, but yet a very broad topic, as Indian country includes a remarkable diversity in terms of locations from deep rural to metropolitan, economic development potential, institutional capacity, and market environment, and thinking here about the presence of native CDFIs and non-native financial institutions, and so on. Discussions of homeownership in Indian country sometimes turn to somewhat vague discussions that try to roll situations across many hundreds of reservations and other tribal lands into an accessible synopsis. Alternatively, researchers have produced case studies that focus attention on a specific reservation or the activities of one organization. Our panel today has walked a useful middle ground between these extremes. So James Colomb provided a useful overview of how the terms of mortgage loans made to AIAN populations compare with those made to other racial and ethnic groups. Focusing on loans made on reservations or near reservations made this conversation particularly useful. The continued increased rate of high-cost lending to AIAN borrowers compared to other borrowers is alarming. James's discussion of potential strategies towards shortening the tribal status report timeline, a crucial hurdle confronting lending on trust lands, is a useful contribution. Shortening the timeline required to execute mortgages and lessening insecurity in the process, all other things equal, should lower the cost of mortgage lending for borrowers and lenders. Miriam Jorgensen then turned our attention to mortgage lending in South Dakota. As we think about the incredible diversity of conditions across Indian country, much of the territory included in reservations in South Dakota is among the most rural and isolated, making mortgage lending on trust lands in South Dakota an important area of focus. Her presentation focused on the results from a survey of mortgage lenders working in South Dakota, but not necessarily on tribal lands. Although the data do not permit generalization across all lenders active in South Dakota, the results did suggest some important potential action areas. Lastly, Crystal Langholtz focused on a very particular type of lender supporting homeownership in Indian country, native CDFI housing lenders. There are presently 69 certified native CDFIs, and from their survey, around half of these either already provide housing products or would like to offer housing products. These organizations are mission-driven to serve the financial needs of their target market, and as such, would seem to be particularly well-placed for both engaging in housing finance themselves and in helping to forge the way for other lenders by developing processes to facilitate lending on tribal lands or trust lands. Their track record in using the HUD 184 program on tribal trust lands as compared to other lenders is remarkable. Her presentation focused on two opportunities for increased native CDFI mortgage lending. One is to increase capital sources for native CDFI niche portfolio lending products. And second, providing training and technical assistance for native CDFIs to connect to the secondary market through conforming products. These two opportunities, or categories of opportunities, seem right on point and would seem to be appropriate for support by increased partnerships or mutual support between native CDFIs and other financial institutions. So with that, I have a few initial questions for our panelists, and then we'll turn to audience questions. And I would encourage you, audience members, please to submit questions on the screen. So for James, it would be useful to know or useful to see how patterns and rates of high-cost lending differ with regard to more finely tuned comparisons. So for instance, there's a relatively small set of lenders who actively engage in mortgage lending in Indian country, and an even smaller set of those that are HMDA reporters. How do patterns of high-cost lending differ for these particular lenders in their lending on reservation and near reservation? Similarly, how does their lending look compared to other specific lenders active on the same reservations and near the same reservations? Somewhat related, I wonder if anyone has attempted to estimate the degree to which delays in the TSR process or other processes unique to lending on trust lands is associated with increased rates of high-cost lending. I guess ultimately the question is, to what degree are higher rates of high-cost lending in Indian country explained by higher lender costs? So I'll let you think about that for a minute. For Miriam, your survey received responses from 18 mortgage lenders active in South Dakota. From this survey and from other research you and others have performed, I wonder about the relative benefits and opportunities that may exist in working with lenders who are already active in lending on trust lands versus focusing on reaching out to lenders that have not yet engaged in this market. What strategies do you see as being promising in expanding lending by lenders already active on trust lands? And what strategies would be useful in outreach to lenders who are active in South Dakota but have not yet engaged in mortgage lending on trust lands? For Crystal, there are 69 certified native CDFIs. What does the environment look like with regard to supporting the formation of additional native CDFIs? Are there notable partnerships or efforts underway that connect native CDFIs with other housing lenders in Indian country? It seems like an opportunity exists for native CDFIs to work with other lenders to improve their capacity to reach the secondary market. And at the same time, native CDFIs could be very useful to other lenders who have an interest in initiating or increasing their mortgage lending activities in Indian country and on trust lands in particular. Are there notable partnerships like this underway to your knowledge? And I'll turn now to let the panelists have a minute or two each to respond to these questions and perhaps to each other, and then we'll turn to questions from the audience. So we'll start with James.
I'm going to start with a question that I think I have the best answer to. And one of those is, to what extent does delays in the unique process of trust land discourage lenders? And I don't know that I have a number amount. That's certainly what they report. But one thing I want to emphasize is that these delays and these process issues they discourage the borrowers themselves, right? Borrowers need a home, and if you're being told that it's going to take a year, or if it turns out it's going to take a year with no answer from a federal agency to even start that process, why wouldn't you just go get a chattel loan for a manufactured home, right? And so certainly, we hear, and you talk about some of these, someone in the chat was talking about lenders moving away from the 184 space. And we've talked to some large lenders about that. And there were a number of challenges. One is this issue of specialization for small reservation markets. But another one was some technical issues interfacing with HUD. Overall, I would say the specific borrower administrative challenges is something we want to continue learning about. And I really appreciate Miriam's work in talking directly to banks about what the problems were. And then as far as comparing lenders working on and off reservations, I think, again, Miriam has done a great job digging into that with the South Dakota Native Homeownership Coalition, but I'm not exactly sure from our data.
Thank you. Miriam?
So I'm going to go to the question that you raised with me first, Chris, and then if there are others, obviously, in the chat, we can talk about those, or you can create more of a conversation amongst us. But I did want to think a little bit about these ideas of how do we think about the differences between active lenders and lenders that aren't yet active in the market? And I think that's a critical piece for people who are sort of serving in this advocacy role. And I think that's what you were getting at with your question, rather than just the idea of, if I'm a borrower, do I go to a lender that is already active in the market, or I do go to a lender that's not active in the market? I think there's a separate set of questions that borrowers need to ask themselves about where to head to look for a loan. And I'll return to that. But from the standpoint of advocacy, and from folks like me and the South Dakota Native Homeownership Coalition, and to some extent, some of the folks attending this conference, we see ourselves more as market facilitators, of people who are trying to help the market work better in various ways by providing information, providing knowledge and research, and looking for some of these barriers and trying to smooth those bumps in the road. So if you're an advocate working in this field, why might you maybe go first to and improve the performance of those lenders that are already active? Well, of course, the answer there is
We seem to have lost audio. While we wait for Miriam to come back on, Crystal, can we turn to you?
Absolutely. Can you hear me well?
Yes.
Okay, great. Just wanted to double check there. So yes, thank you for your questions. And I was really excited for Miriam's, so hopefully your audio comes back.
Well, Miriam, if Miriam's back, we could hand back. I'm not sure how to do this.
Can you hear me now?
Miriam, are you there? I can hear you now. Yep.
Okay. I'm not sure how much of that answer you heard, but I was basically saying that it is important to continue to engage with lenders that are already active in the market, because they're the ones who already have a bunch of knowledge and information, and to make their job increasingly easy is important. So continuing to communicate with them with the latest information about how the TSR process is going, if there are any changes in it, if there are changes to the rules and regulations around the federal loan guarantee programs and other kind of risk reduction programs. That's critical information to those lenders so that they can keep that flow of lending into the market going well and smoothly. But I think that there's benefit also to engaging with those lenders that are not yet lending in the market. And in part, that's because we actually see, and you've heard this from all three of the presenters, that there might be a rising wave of demand in this market. And it's likely the case that if this takes place for the next 5, 10 years, 15 years, that those active lenders are not necessarily going to be able to meet all that demand themselves. So having advocates engage with those that are not yet in the market is really critical as well. They require a somewhat different kind of information. Sometimes it's more starter information, but hopefully as advocates, we can reach out and address the specific needs of those lenders too. And again, I come back to one of those critical pieces of information is helping those lenders not yet active in the market understand that there are ways to cover their risk.
Terrific. Thank you. Crystal, can we turn to you?
Absolutely. So to answer your first question, there is a growing wave of emerging native CDFIs. So in addition to the 69 certified native CDFIs, there's usually between any given time between 15 to 20 emerging CDFIs, native CDFIs that are growing in this space. And we at AWISTA are happy and excited to always work with those emerging native CDFIs. And then more start every year. The CDFI fund does have a set aside for emerging groups, technical assistance money that helps the creation of new native CDFIs. In addition, we also see the expansion target of to serve other reservations and statewide of that increased scope of existing native CDFI lenders. And to answer your second question, there's a lot of great examples of these kinds of partnerships in place. An example would be, for example, Cook Inlet works in partnership with another lender and does brokering for them. So I did have that slide about the different kind of brokering relationships that are out there. And there are those kinds of referral partnerships as well happening all throughout Indian country, and more getting started every year. I think there is a space to see a lot more of that. One of the challenges that our native CDFIs, as we think about how they can work with lenders that we're going to have to come to terms with, is that it's really important for our native CDFIs to service their loans. That is one of the ways that they maintain a quality portfolio is through continued relationship with those borrowers. And so that is a need that many native CDFIs have in that space, that as we think about secondary market access or partnerships or working with aggregators, that we would have to think about how we can make sure that there's room for those kinds of relationships, and that there's ways for our native CDFIs to maintain partnerships and relationships with their borrowers. But I think there's a lot of room and space for that. And I think if the GSEs are willing to engage and think about that as well, that the sky's really the limit on and partnerships and how that could potentially work.
Terrific, thank you. We have a couple questions from the audience. The first one, this one was pitched to Miriam, but I'd throw it out first to Miriam, and if anybody else wants to weigh in as well, that would be great. The question is, what is the role of social media among the Native American single-family home buyers?
So I can't give you a specific survey-based answer to that, but I will tell you that when we asked how to reach out to folks, we had a very high response that social media was an important way to go. I will also tell you that other research suggests that on-reservation Native communities have been very high adopters of social media and active users of things, like I said, of Twitter and Facebook. So they are very important information mechanisms. So it strikes me then that, of course, that feedback that we got on our limited survey about Facebook and Twitter and other forms of social media being important for information about the home mortgage process makes sense.
Thank you. James or Crystal, do you have any thoughts on that?
Yeah, I would just echo Miriam's comments that anecdotally, absolutely, social media is very important. Facebook especially is well used in many of the communities that we work with and engage with. And I think it's really important also, one of the things that needs to happen and is that our native CDFIs are working on is creating the perception of homeownership in the communities, right? In some communities where there hasn't been a strong history of homeownership for many generations, there's a need to sort of rebuild and retell that story. And I think that social media especially is one of the vehicles that can be used to do that. So I see that as a really important way of outreaching to the markets, yes.
Thank you. James?
No thoughts on social media. That's not something we've looked into at the Fed, other than
Fair enough.
thinking about the relatively low follower accounts we have.
Fair enough. Question for Crystal, and again, open for anybody else, but have you seen any changes since the Great Recession and the foreclosure crisis years?
As far as native CDFIs engaging in this space?
Yes.
Yeah, absolutely. In general, I would say that the foreclosure crisis in Indian country was different in that, many of our native CDFIs were working in highly communities that had highly recessive economies to begin with. And so many of our native CDFIs actually, in many ways, like they're doing with COVID right now, were able to be very responsive in the crisis, and it had a different sort of impact than what we saw kind of in the general housing market. But I think that we have really seen I think it goes more to this idea that Miriam has around our native CDFIs really engaging in this space in light of the growing demand in the communities that they serve, which I think are more related to some of Miriam's comments about the kind of growing middle class, or what we would call a more high financially stable economic environment in some of our native communities in response to the economic sovereignty movements that's been happening all throughout Indian country, and how that has improved credit scores and built demand. And so I would say that the timelines do, that it has actually, a lot of that has emerged since the housing, since the Great Recession, but I feel like the correlation is broader than that, in that it's about this broader movement that's happening all throughout Indian country. I hope that was clear.
Actually, Crystal, I'll pick up
really
on that,
helpful.
because I think in many ways, my answer would have been exactly the same. That on some level, the foreclosure crisis that followed the Great Recession, sort of that from 2009 onward period, which was very rocky for mainstream homeowners, and everybody saw the pictures of the houses, block after block that were foreclosed, things like that. That much of the volume that we've seen in the uptick in the conversation around Indian country homeownership has happened after the Great Recession. So to the extent that there was an impact in Indian country, certainly it was there, but the numbers were much smaller. And more than that, a lot of those homeowners already had the kind of relationship that Crystal's talking to you about, where there was a native CDFI or other facilitative financial institution that was going to work with that borrower. Even I will tell you, probably when the loan wasn't still with the native CDFI. Because one of the things we see native CDFIs doing is that they are quick response organizations. They identify a need in the community, they apply their resources and capital to that need, they figure out a way to assist their client and customer base. And so they're able to respond quickly and effectively to those crises. So certainly we're seeing that now in the COVID crisis, as Crystal points out, that there's this responsiveness and this ability to react and respond to where the customers are at and try to keep those loans safe and stable. But there also is this other thing going on, as she pointed out, that we're having this ongoing growth in the economic sector, or in the economies overall in Indian country. So on average, right? So not every place and not everywhere, that's what an average means. But we do have this rising middle class. And for many of those individuals, they are in situations where they can maintain their loans and continue to pay and continue to be good customers for banks or CDFIs.
Great, thank you. And with that, I've got a flashing light saying that we're over. So let me bring this to a close. Thank you, Crystal. Thank you, Miriam. Thank you, James. And thank you, audience, for attending today's sessions. We look forward to seeing you all tomorrow at 1 p.m. Eastern Standard Time for day 2 of the Rural Research Symposium. Thank you very much, and good evening.
Thank you.